We got another business for you today. It's a plumbing franchise. And I thought this was kind of interesting because looking at plumbing businesses or HVAC businesses, the numbers are all over the place in terms of multiples. Franchises, though, as I mentioned in a couple other videos, there's a lot more of these coming up because even with franchises, a lot of the owners are in the same age range. But franchises are all about cash flow. You're not really going to get a ton of value in the arbitrage of the value of selling a franchise, but you do get a lot of cash flow when they're well run. And so this is an interesting one. It's a plumbing franchise. They're doing 729,000 in cash flow, and the reality is with franchises, this is often a relatively decent number. It's likely that there are ad backs and other stuff in here that there really shouldn't be, but usually you have to run a franchise pretty clean because there's other companies, the top level company that's relying on your numbers and your accounting numbers. So there's good potential this number is actually relatively accurate. And based on a ratio of their revenue to cash flow, this number is probably in line. We've seen a lot of plumbing companies that are operating at 25 to as high as 35% net margins. So, we're hovering around the realm of like a 20%. So it's probably pretty accurate with franchise fees and everything else. But also, this isn't a round number, right? Not being a round number means they've done some calculation, so they have the raw financials to work with, which is also a good sign. They got $183,000 in inventory and a bunch of equipment. This is probably fleet and vehicles, both of which usually in the purchase price of a franchise. I mean, you're getting this stuff for pennies on the dollar. To be honest, you're also buying their cash flow for pennies on the dollar compared to another company. But that's what you get when you get a franchise because you have to follow rules and regulation. So interesting franchise, a full service plumbing company. It's in the it was the South Carolina area. So for whatever reason, North Carolina kept coming to mind. But it's in South Carolina. It's a good market for plumbing. Um, Overall, it's a pretty sounding business. They lease the real estate. Obviously, they don't specifically mention whether the business owner owns this or not, or whether they've just been leased entirely. So worth having a conversation to see if there's something that can be done there if they own the real estate. But otherwise, I mean, you're getting all the vehicle fleet and everything included. You're getting a lot for what you're paying. SBA available because SBA loves franchises. The owner is ready to retire, and this is perfect. The children have no interest in it. Perfect scenario. And the transition likely will be as smooth as you can make it because the franchise is involved in this. They're going to care that it gets operated in the same way moving forwards. And so while they say 30 days, it's going to be purely negotiable on what you need. If you say you need 6 months or you need 12 months, the franchise will pressure this franchisee in ensuring that you get that. So that's why I really like franchise businesses from this perspective, especially these ones that are coming up. But in general, I'm more of a value buyer in the sense of I like the arbitrage more than cash flow. But if cash flow is your key and you want to start stack cash for whatever it is, for real estate, for a second business, whatever it is, franchises are good ones to look at. So this is a pretty interesting one. I'm going to show you the numbers in two different ways because folks have been asking, seller finance versus investor versus whatever the case. I'm going to walk you through two scenarios here. And the reason why, I'll zoom this in a little bit, the reason why I focus on seller finance versus bringing an investor into play. Because there's lots of other folks out there. They say, bring an investor into play. They're going to foot the bill for 10%, 15%, whatever it is, and they just buy them out later. You don't have extra debt. Debt in this case is way cheaper, and I'll explain to you why. But this is always scenario dependent. There are deals we're working on with partners where they have to go this route because the deal otherwise won't make sense to go this route, or the seller's not willing to go this route because of the amount of buyers that are coming into play. So it's always scenario by scenario, but I'm going to walk you through how we would look at this from either scenario and what that looks like in actuality. So revenue 3.4, cash flow 729. I'm assuming they're going to probably want 2 times, 2.25 times. Maybe you settle on 2.5 times with the seller finance you want, or 2.5 times with the inventory included, or however you want to adjust it. Chances are you can probably get this for 2 times if you really play hardball and there's no other buyers. But I'm going to assume a relative worst case scenario here at 2.5 times. And one scenario here being seller finance, this being an investor, so seller finance being the owner acts as the bank, and typically we negotiate that as 0% interest and fully delayed and deferred to the bank. So 25% is usually what we ask for. We start at 40% and we try and negotiate down to 25% and settle at that. If it needs to be 15 or 20%, so be it, it's more what the banks are willing to accept than what the seller is willing to accept. The bank's saying okay to 20% or 15% or even 10%, seller finance will take it all day long. So let's assume it's 25%. Actually, let's assume it's the same, just to work out this scenario. Let's assume it's the same as an investor coming in. In the investor scenario, you ask for 15%. They're putting in $273,000, right? So in either case, you're filling the bank's gap of what they want to see as equity. So you're financing 1.5, typical terms that we're seeing 11.5 for, relatively non-shop deal, 10-year amortization. So after all is said and done, you're still making a good amount of cash, right? 2.7 times debt service. It's because it's a franchise. It's all about cash flow. You're going to be able to pay yourself a good chunk, and in reality, probably get a good manager in place. This one seems like it's currently operated by the owner as a full day-to-day, but you'll easily be able to bring someone in at that to manage it if you really wanted to. So let's look at the equity side, like what it's going to take to actually buy out this company at this stage. With seller finance, you own 100% of equity. All you have to do is pay off these payments whenever you choose to. You make enough every year to just foot the bill and pay off the investor if you really, the seller finance if you really want to. But more than likely, your best case scenario is just stack this because there's no value arbitrage. Just stack cash, pay over as long of a period as needed. If anything, at the end of the 10 years, you pay off the seller his extra little bit, and you're good to go. In an investor scenario, what we've been seeing with where the market is now is when an investor comes in and puts down, say, $200,000, when you don't have skin in the game, you're just the SBA holder. They're expecting that their money is going to double in terms of equity. Some it's 1.5 times. So they put in 10%, they expect 15% in equity. Most that we're seeing right now for quick investors not having to shop a bunch is 2 times. So if they put in 10% of equity, they expect 20% of equity as like the basic return, their value arbitrage. And some, the higher end of the market, are asking 3 times. So if they come in with 10%, they want 30% equity against that 10%. So day one at 2 times, at the average of what we're seeing out here for quick deals, you would only own 70% of this business day one. And then often when they're asking for a smaller step up, that's what we call it, a step up, where they're basically putting in money, but they're getting a higher value of equity for that money. They often require some form of, it's not really interest, but it is interest. It's called a preferred payment. And usually that's just a percentage against the amount that's invested. So that is effectively interest. It's just guised differently for the sake of the bank being okay with it. And so that pref payment, you may not actually be paying this. This may just be accumulating. But on an 8%, which is pretty low end of typical, usually it's 10 to 12% that we're seeing again, because the market's getting aggressive with this. A lot more people buying companies. And so investors are definitely seeing the value arbitrage. This would still accumulate, right? So if you aren't able to pay that for 10 years, you're going to owe them another $200,000 in preferred payments by itself. Let's say you're paying it every year. So you're netting cash flow 446, not vastly different, right? It's only 20 grand a year. But oftentimes you have to obviously buy the investor out. And sometimes they're going to be okay with saying, well, hey, I own 30%. What's the value of it? Let's say, right now, current value being 2.5 times, you're going to have to pay them $547,000 to pay out for this 270 they put up. But in most cases, you've grown the business. And so this only increases. And so now over 10 years, you might owe them maybe 1.5 times this amount if you really didn't grow it that much. But you're also going to owe them another 200,000. So this $273,000 is actually giving them over a 3 times return on their money that you have to pay out. That's why we like seller finance as much as possible. Because even if we put a small interest rate on this, we do the same 8% interest, I don't need to pay them out to buy that equity. I've already paid for it. I'm paying for it over time. Or if we do no interest like we normally get, it's just a lump sum. It's 270,000. It's much easier to digest than paying someone out 700 grand or 800 grand at the end of just finishing paying off the bank. So both scenarios can work. And at the end of the day, you're still cash flowing enough that it makes sense. But why have someone come in and eat up that equity if you don't need it? Right? That's the scenario we like to keep in mind. That's why I always show seller finance first. If you absolutely need to, you can look at an investor, but I wanted to show you the reason why. So overall, this is an interesting business. We don't have anybody on this side of the U.S. as a partner, but if you're in this area, would be an interesting deal to look at if you're mainly looking at cash flow, because you can really get 400,000 plus a year. And after placing a GM, if you give them a little bit of equity, even after placing a GM, you can probably still cash flow like 275, 300, assuming that the cash flow numbers are accurate. They're probably somewhat accurate, but always depends. But you can still be cash flowing a good amount of cash and be able to pay this off over time, stack, a couple $1 million during the time that you're running with the bank for 4 or 5 years, and then look at, potentially a secondary acquisition or sell this and then use that plus the cash that you now have and put that into a bigger size company. And, you can add some significant value. But lots of things you can do with these types of businesses. Franchises are always good. So I thought this would be an interesting one to break down, and also an interesting one to show you the investor versus seller finance scenario, what it really looks like. Now, all of this is based on current time. So what we see from investors right now, today, if we were to reach out to someone, that will always change in the future. It might go lower depending on how much activity occurs, but based on where investors are at and how many people are sitting on money, that's likely only going to go up in terms of greediness of want of return. But that's where the market's at. So if you aren't, or if you're watching this on the YouTube channel and you aren't already in our Facebook group, click the link down below to join that. If you're in the Facebook group, obviously let us know if you want to see any other types of companies that are broken down this way, and look forward to the next one.